Hello and welcome. Now, small caps are where investors often find the next big stories, but they come with their share of sharp ups and downs. Samco's new fund adds an interesting twist to this space. It's India's first momentum based small cap fund built to capture emerging trends early. Joining me to explain the idea is Viraj Gandhi. He's CEO of Samco Mutual Fund. Welcome, Viraj.
Thank you. Thank you to the entire team and thanks to you, Ruchira, for allowing us to, present our view to your customers, to your clients and to your readers.
Sure. Let's start with the big idea. What made you choose this theme and why launch it now?
See, first of all, let me go two steps behind to explain it to you. When you do momentum style based investing,
Mhm.
it's always the biggest alpha creator. If you take an history of the last 20 years of data of the Indian capital markets, alpha, every investor wants alpha to their portfolio.
Mhm.
The biggest alpha actually comes from by investing into the style of momentum. But it works brilliantly when the market is trending up. So it's a time when you have to invest into the market and when you expect the market to double from the current level of 25,000 Nifty to 50,000 Nifty in the 5 to 7 year period. Now, when this kind of wealth will be created, the major beneficiary of this movement is going to be the small cap segment.
Mhm.
Plus, when you add the style of momentum to small cap segment, one, you have already got the alpha by investing into small cap. Second, the biggest alpha will come from the style of investing through the momentum pick. Now, when you combine both of it, the momentum style plus the small cap investing horizon. So, whenever we will see the market trending up from 25,000 odd Nifty today to 50,000 in the next 5 to 7 years, the biggest alpha and the biggest wealth will be created by these two combination of small cap and momentum. That's why we have chosen that.
All right. But momentum, it also is usually seen as a short term trading style. So, how are you adapting that concept into a disciplined long term investing approach?
So there is a certain misconcept about momentum and there is certain understanding that one need to have that yes, momentum lives for a short period of time, but
Mhm.
what it does in that short period of time is a long lasting impact. So for to explain this, I am going to use an analogy from the cricketing world that whenever you play cricket in the shortest format, which is a T20 format or a one day format, there are people who go for their averages that I score 40 runs, 50 runs every match. But there are people who come and provide that impact through the strike rate game. So the Rishabh Pants of the world, the Hardik Pandyas of the world, Abhishek Sharmas of the world, from the women cricket team, the Ruchira Ghosh of the world, and the Shefali Varmas of the world create that impact through the higher strike rate. Now,
Mhm.
momentum is actually a strike rate game and not an average game. So, when you compare the lasting effect of momentum in terms of time, yes, the averages will win over them, but the impact that it will create in the shorter time frame will be far ahead of the impact that is created over a long period of time. So momentum, yes, will come in bouts, will come in short time frame, but in short time frame it will go so far ahead in terms of the investment philosophy that it will create that impact and alpha of any particular investor and will generate a higher return compared to any other style of investing.
Okay. And momentum strategies, they can run into sharp reversals or false signals. So, what are the biggest risks and how have you designed your model to manage them?
So what we have understood about momentum is that momentum is usually a 2x factor. Meaning when Nifty goes up by 20-25%, momentum indicator or the momentum index you typically goes up by 50, 60 or 70% also, which we have seen in the last 2-3 years. Now it is true when it is reverse also. When the market corrects by approximately 10-15%, which it was the case between January to March of 2025, momentum index is actually corrected by 2x times, which is approximately anywhere between 20 to 30%. So as you rightly pointed out, that it is always going to be high risk, high return product.
Hmm.
So people generally say that they want the returns of momentum in a good market, but they don't want to see the volatility of the market in the short period of time. So there is no such product like a low volatility and a high return product. So momentum is always going to be a high risk, high return product. So for one to absorb that risk and also see the fruits of the return over a long period of time, they need to keep their allocation in place. They need to make sure that the allocation is to that extent that they can absorb that volatility and they can, see the rewards of that particular style over a long period of time. So again, going back to the cricketing world, you can only have one or two Hardik Pandyas in a playing 11. You cannot make the entire team of all 11 Hardik Pandyas in the team. So he can come and give you that impact, and that is the right approach for the investment perspective, that they need to keep their allocation so much in control that they can absorb that volatility. According to us, at this point of time, it should be approximately 20% of your portfolio, not higher.
Okay. All right. Now, you've built this fund around your CARE framework, the cross sectional, absolute revenue, earnings momentum. So, for a regular investor, can you explain how this helps you pick promising small cap stocks?
It is very important to understand the reason why the stock is moving up so fast.
Hmm.
So one has to understand that the fundamental of the company, the top line and bottom line growth, is what it has to be. So whenever a company has a price momentum, it has to be backed by a earnings momentum. That becomes a stronger momentum play. So, and also we see the absolute momentum of the company and the relative momentum of the company. So for example, there is an XYZ company in a banking index. It has gone up by 20%. So in an absolute term, okay, it is having momentum because it has gone up by 20%. But in that same time frame, let's say the banking index itself has gone up by 20%. Then on a relative term, it is not having an additional momentum. It is only having a neutral momentum. So for you to understand momentum, all four parts are important. That whether first stock is having an absolute momentum or not. Second, does it have a relative strength or not? Because we need to beat the benchmark. Third and fourth is the top line and bottom line earnings momentum. Whether the company is growing its top line, whether the growth in the business is there, and whether it is able to protect its margin on a higher base and maintain the bottom line momentum. So, when you combine all of it and create a model of momentum, that is a very, very strong model compared to just following a price momentum model.
Okay, Viraj, you mentioned that momentum is the biggest alpha creator, but what makes this the small cap universe particularly suited to momentum investing compared to larger companies?
See, what happens is in a traditional fund management setup, the fund manager is actually dependent on the research done by the research companies, which is not part of their team. So
Mhm.
they need to buy research from the research based firms. So, for example, I'm Samco Mutual Fund. I have a team of fund managers and I have a team of research analysts. They typically go to a sell side analyst and understand from them which are the companies which are looking great, the sectors which are looking great, and they give you the ideas of investments. Now my analyst actually works on that ideas and present that idea in the investment committee if this was a traditional setup.
Hmm.
Now this research is limited to the first 350 companies only in India.
Mhm.
We don't have a meaningful research or a competitive research in the number below 300 350. The first 300 350 companies are very well researched in India, but when you do small cap investing, it is actually ranking from 251 to 750, the small and micro cap index. And the number of newer IPOs which are available on the street today and are getting listed so regularly. So the research capability of finding the newer investment horizon becomes smaller and smaller because you don't have research there. Then how do you invest into that company? How do you take a informed call in that company? How do you find the next multi-bagger in that segment? How do you find the next wealth creator in that segment? You are reliable on some data points which are just not available outside. So we created momentum models for the small cap space particularly, and I'm very, very proud to tell you that there were few of the companies where we were the first mutual fund to buy them. in the
Okay.
last 3 years. There are few of examples in my portfolio. I am not naming any one of it at this point of time. But if you take my portfolio into my other schemes, there were you will find at least 8 to 10 new names where we were the first mutual fund to identify them, buy them, hold them, and create that wealth into my different schemes. So now think of it that there was no research on this company. When we
Hmm.
bought them, there was absolutely no research on this them company. So when there is no research, there is nobody to come and tell you where to buy them. We bought them because we saw price and volume momentum in that particular segment, and we bought them. And we create so and that company has actually created a lot of wealth for our investors. So particularly for small cap, identifying the next big opportunity through the momentum segment becomes even more important because of the limitation of the research capability.
Right. But when it comes to small caps, liquidity and execution, they are real challenges. So, how do you control portfolio turnover and impact costs without compromising returns?
This is a very important and fundamental question, and thanks for raising it. See, when we created our models, so what does a model answer us? What to buy, when to buy, how much to buy, and when to sell.
Hmm.
Now, what to buy is clear through the momentum model that we want to pick up this particular stock because this particular stock is showing price and volume momentum. But how much to buy is also been answered through the model. So we have made models so competitive that it will look at the price volume, you know, price and volume movement for the past 6 months, 12 months, but it will typically see how much was the delivery volume in the past 1 year on a particular segment and how much can we participate. So we typically see an exit option before we enter a particular stock. So if we want to, so for your understanding, today I manage approximately 3,200 crores of AUM.
Hmm.
Out of my entire number of stocks that I've invested into in different scheme, there are only 3 to 4 stocks which I will take more than 1 day to liquidate. Okay, rest 98% of my portfolio can be liquidated in 1 day. What does it mean? It means that while buying a particular stock, there are certain restrictions, there are certain, the firewalls that we have kept, which will tell me exactly how much should I invest into that stock at this point of time, considering the volume of that stock on delivery basis and also the kind of portfolios that I'm managing, and the combination of that gives me such a hard entry, into illiquid stock. That's why I don't find myself getting stuck over there. So getting out of it is equally easier because at entry level only I put all the barricades.
All right. Um, Now, who is the ideal investor for this fund and who should probably stay away from this fund?
Again, if you have a 5 year horizon, point
Mhm.
number one, if you have the stomach to withhold the volatility in that 5 years when the market will turn bad, only then you should be investing into this fund in the lump sum basis. Otherwise, you should only choose an SIP route. So, point number one, you need to have more than 3 to 5 year view. You cannot have a short term view, particularly for cap segment and also for momentum style. So, you cannot, this is a very important combination that I want to explain to our customer, that the very reason for you to invest into this fund, that it is small cap and it is momentum based, which can generate so much of alpha. So again, taking the same example of Hardik Pandya, if Hardik Pandya gives you fours and sixes, he's going to put the ball in the air, and there will be chances of getting him out because he's trying to hit a six. So ultimately, till the time you cannot, stomach the volatility of small cap and momentum in the coming period, make sure that the asset allocation to this segment is very, limited to only the 10 to 15 or 20% of your portfolio. And once you do that, and once you stay on course for a longer time frame. So why are we seeing a longer time frame? Because the historical data of momentum study shows us that if you have invested in a momentum style, be it large cap, be it mid cap, be it small cap, there are a lot of momentum indexes that are available outside. And if you take that data from 2005 to 2025, there is a good probability of more than 90% in your favor beating the benchmark if you stayed on course for more than 5 years, which is a very, very high probability in your favor. And that's why we are saying that you need to have a 5 year view for momentum style. And particularly for small cap, you need to have a highest volatility absorbing capacity so that you can make sure that you create that kind of alpha over a long period of time, but the short term volatility will stay.
I'd like to go back to the point where you said that when you're buying, your model tells you when to sell. Also, that you have it in mind already when you're buying a stock. So big rallies followed by deep corrections. That's how small caps tend to move. So how does that strategy respond when the cycle turns? If you can elaborate on that.
So what happens is, as again from a traditional model where you take a contrarian view to the market. So a traditional model will tell you that the market is correcting, the value has emerged, you go out and start buying. Okay, so you are typically going against the market view where the market is correcting and you are entering the market, and vice versa. Momentum model are actually trend following models. So what do I mean by trend following models is it will typically find you the stock where the momentum is getting built and also the stock where the momentum is getting lost. So you don't buy on the way down. You only buy when it is showing you the way up. So what do I mean by trend following is there is a very famous saying that market knows everything, market is supreme, and the collective wisdom of the market is far higher than your and my knowledge. So we in trend following model, I don't go out and buy in a falling market. In fact, on the contrary, when the market is showing signs of reversal, I start reducing my equity exposure. And when market starts stabilizing and starts showing an uptrend where the momentum is getting built, I typically start building the portfolio when the market starts showing the strengths, not otherwise. So it is very different than your traditional model because in a traditional model, you will typically buy when the market is falling. So in a momentum model, it doesn't work that way.
Right. Okay. Now, both momentum and small caps, they can test patience, as we've discussed also. So, during volatile times, how do you plan to help investors stay disciplined and invested for the long term?
So we constant communication and understanding of the model of what we have created and what we are doing. That constant communication is the key to stay on course for a long period of time. So not only momentum, you take any other model. Let's say for a good period of 7 to 8 years between 2010 to 2020, it was the growth which was moving very nicely, but the value underperformed. Between 2020 to 2024, really after the COVID, because the interest rate went up, it was the value stock which actually rallied and the growth underperformed. So there are cycles for all kinds of investment, and market will also work in cycles. So for us to explain it to the investor, it is very important us to understand the market cycle and the cycle of the style of investing that you have adopted and communicate it effectively to the investor as to what segment of market you have invested and what cycle you have invested into. Once you can match that and explain it to them, I think then the journey becomes even more important and effective, and also it stays for a long period of time.
All right. Well, with that, time for us to wrap up this conversation. Thank you, Viraj, for sharing your insights.
Thank you very much to the team Value Research, and it's a very humble request to all of you that you have supported Samco Mutual Fund in most of my offerings. Look at this as a very, very differentiated offering, a very important offering which can actually create a lot of wealth for our investors over a long period of time. So stay on course, make sure that you are there when the journey is beautiful and also fruitful. So thank you very much.
Great. All the best for the launch, and we'll be watching how this story plays out. Thank you.
Thank you.